All right, good afternoon, everybody. This is Gavin McGuire, Event Trader, and I am being joined by Brett Manning, Chart Trader. Brett, how are you doing today?
I'm doing good, Gavin. How are you?
I'm doing good. I'm doing good. Just getting ready. We got our latest version here of the Sentiment and Flow Show, and I think it's an important time to discuss what's going on in the markets here, Brett. Certainly feel like we're hitting an inflection point. You're seeing a ton of arguments about whether or not this current part of the rally has extended and kind of hit a stop sign here, and whether or not we'll get a rollback or if we'll just kind of go sideways and then go up further. Now, obviously, there is a lot of variables that are going to be involved here, probably more so than usual, and certainly a big outlier in which we really have no way of mapping out which direction this COVID-19 is going to progress, and that kind of is the key underlying story behind this whole thing. But with regards to where we stand right now, do you have any thoughts on the market activity that we've seen over the past week?
I think that the tape to me right now feels, whether the pattern is there or not, it's of the personality of an expanding triangle, and by that I mean, I think people are getting what I call getting burnt across the middle a lot right now. And it's tricky, and it usually is in a market that's having a really difficult time with price discovery, and also has kind of found a point where it can't find the next discounting direction. So we're in a state of limbo right now between, understanding the plausibility of a V-shaped recovery and not. And burnt across the middle basically means you get a sharp move up, and then you get a pullback, and a lot of traders are looking to buy that pullback because we're seeing an upward trend, and that pullback goes from being a pullback in an uptrend to suddenly dumping all the way back down to the root of the initial upward move, and then you get a bounce, and people start shorting that bounce, and then gradually that morphs into a squeeze and heads you all the way back up to the top. So it's kind of the personality of an expanding triangle, and we've seen that for several days now. And it's a tricky dynamic to trade because you get people burnt enough times on that kind of pattern evolution dynamic, and you really start to get some liquidity that disappears in the middle of the pattern. So you get these very sharp moves in the middle of a really choppy pattern, which really makes trading difficult for short-term players. And I think that that's all a consequence of, like I said, that we're kind of at this, and it's similar. Last time we did the show, I brought up the idea of the entire S&P is like a biotech approaching a PDUFA date, and it's kind of the same dynamic here. There's this line that we either cross or don't cross into a sort of dystopian economic future, and it really depends on the degree to which we're able to find an innovative solution to get things opened back up and moving over the relatively near term.
Yeah, and again, obviously some major questions out there in terms of even valuations and trying to model that we're not really getting any particular answers from. We got earnings season coming on, but the early returns have been relatively, this is more or less a throwaway earnings season because the numbers, Brett, so far have not been particularly horrible, particularly when you're looking at the semis. They've been thriving in this work from home environment and the teledocking going on and all things along those lines. But even taking a look at the banks, which we got the big money centers this week, certainly some of the regionals, the figures have been decent. But of course, Q2 is kind of the big question there, and nobody has an answer for it right now. And I think that's being reflective in the market activity, kind of as you say. It seems like that little choppy middle has been left up to the algos, and I was just watching a 10-part World War One documentary series, and it's kind of like that no man's land in between the trenches of the Bulls and the Bears, where everybody's getting chopped up by the mortar fire from either side on that, and just waiting for some sort of break in either direction.
Absolutely. Follow through is difficult
Yeah, the follow through's difficult. We've been
because there's
seeing,
no basis for it either way.
yeah, yeah.
We just don't know.
I mean, have you been following the COVID numbers? I'm sure you have been. Has there been any particular number that you've been paying a little bit closer attention to? Certainly, there's been some signs of improvement, but they obviously remain at elevated levels and unacceptable levels from a humane perspective. But is there anything that's been jumping out to you on those particular data points?
No, I mean, I think that it's a disjuncture that we're kind of staring into, which is to me, we're either going to figure out how to do, and I based my notes on it this morning. We're either going to figure out how to properly implement test and trace, or we're going to have a bad time. And I think we're going to figure it out. I think that that's where this is going to eventually end up positioning itself. And so the numbers right now don't reflect that. Social distancing is our. You ever see the movie Predator?
Yeah,
Okay, you remember when he's got his cloaking thing on? We don't know
sure.
where he is. There's nothing you can do to fight that. You
Unless he
just have to,
bleeds.
yeah, unless he, well, okay. There's one thing of showing where he is, right? But when he's not bleeding, like you just can cover up and hide, and you're probably gonna die.
Right.
Like that's the only method you have of fighting against the predator when he can cloak himself. So when you don't know where the enemy is invisible. There's nothing you can do except for the most extremely conservative thing that you can do, because otherwise, you're out in the open and he's clawing you up. So
But if you
that's
don't
what
have a
we've been.
weapon, he won't attack you. For what it's worth.
Okay, well let's leave the predator scenario behind. Just go with the general concept of
I understand where you're going from.
an invisible attacker. You cannot see it, you don't know where it is. Or let's say something with night vision. You walk into a room that's dark, completely pitch dark, and something else has night vision. Same situation. You don't know where it is, where it's coming from. It can just do whatever it wants to. So we're in a situation where we're fighting that war right now, and the only thing that we can do is cover up, and that's what we're doing. And that's the most destructive thing. But gradually, we start to develop tools, because this isn't 1918. This is 2020. We have mad skills on the technology front. We can figure out different innovative ways to start to understand where the enemy is. And I think that process is starting to get traction. I
How
think we're starting to see initial signs of that. And once we understand where that monster is, well, guess what? A few iterations down the road, in terms of people reacting and living in an environment where we understand more about where that is, things start to open back up, because suddenly people can go out in their communities. They can know exactly where the enemy is, and it's not in their community, so they don't have a problem. The economy heats back up. So I think that is the reality that we're staring towards to some extent. I'm starting to get a feeling that that's the world we're headed toward, and you can't see that in the data. You can't see that in the economic data. You can't see that in the earnings data. You can't see that on the Johns Hopkins page, but it may still be where we're heading toward. And the market, I think, has to take a very realistic view, given the exposure levels that we're about to talk about, how much cash there is, how much fear there is, how much pessimism there is. If we're starting to head into a world where we're gradually developing the tools to understand more about exactly where this enemy is, then there's no data point that's going to show you that, but the market's still going to have to price accordingly at some point, if that's what we're headed toward. And I think we're on the line right now about whether or not we're going to be able to find that kind of solution.
Yeah, and certainly there's going to be a lot of interesting debates around those solutions. You're already starting to see the big brother arguments about being over intrusive, but I don't see any way around it. I mean, if you don't like it, then you're going to have to stay in your house, because I know in China they've certainly started implementing the QSR codes. They are also implementing the tracking devices there. They're having success in that, and it's going to be a necessary function at least
Look,
until we get a vaccine in place. So,
it
um,
is not it is not impossible, and it would work. And those two statements are true. And so it just comes down to implementation and execution. And I think that we're going to figure that out, because the alternative is, let's walk into a depression,
yeah,
and a lot more people dying. And I think that argument is an easy one to sort out over time. And we're talking about, not. I mean, let's examine the bear thesis, the idea of the S&P at 1600. What causes that reality? That reality is one where we have waves of outbreaks and shutdowns until the middle of next summer, and there are businesses broken forever, and the bridges, the hole is deep enough, and the bridge is not long enough for us to be able to use policy tools to truly maintain anything there. And we also have a long enough period of time where it changes the way that people behave on a fundamental level. New habits are formed, in terms of consumerism and ideas like that, where, you've got your own philosophical idea about that. But as far as returning to the type of economy that we had before this, you're just not getting back there. And that's the world that takes the S&P to 1600. And it seems to me like that choice is becoming more and more apparent, and it has to do with us developing innovative ways to deal with this, to just snuff out this problem. And I can't imagine that collectively we're going to make the choice to enter into that kind of that region of the outcome distribution.
Yeah, and there's certainly a lot of interesting tests going on. We obviously have Sweden, Brett, which is the only country that hasn't done the stay-at-home, where they're doing their pods and their herd mentality in order to kind of keep everything isolated there. So curious to see how that's going to follow out. And certainly it seems like even here in the United States, there's going to be a split between states on who's staying open and who is kind of going to go, quote unquote, back to work, if you will. You're starting to see a big fight in Michigan. So it's good. The next few weeks are going to be interesting, but it's going to take us a while to get any sort of historical data behind what's working and what's not. But I agree with you. Until they get that testing in place and the tracking, it's going to be impossible to have any sort of big live events. You're going to have certainly pockets of strength in the economy on areas that you could get by without massive groups of people. But the rollout's going to be slow, and it's going to be tedious, and it's going to be.
It is, but as long as we can get back to something where we've got this, kind of compartmentalized by
Right.
July. You've got a reality that we can paper over. You've got a small enough amount of time that people aren't fundamentally changing to too great an extent in terms of how they behave, to return to an economy that functions. So, that's still an uncertainty, and the market is still dealing with trying to parse that out.
Right. I would say one thing that's important to note that the financial stability certainly cooled off a little bit here, or stabilized, I should say. I was going through the IMF Financial Stability Report, and there's certainly a lot of question marks, as you say, Brett, if this continues to press on. But right now, I was on all the recent Money Center calls, and just data that you're looking at out there, definitely looks like the Fed stepped in enough to stabilize the markets on the financial side in order to give us a chance to cross that chasm that we're certainly seeing here right now. And the economic data that we started to get, it certainly plays out. So with that, let's take a kind of pivot towards the sentiment data, and we can really see what kind of chasm we're talking about here. Just started to get in the harder data, but the sentiment data is a little bit more of a forward-looking point, is definitely pointing to the concern that's out there in the markets. And just curious as to your thoughts, if you've had a chance to take a look at either the New York Empire or the Philly Fed numbers, Brett. New York Empire, for instance, fell to 78.2, or minus 78.2. That's the lowest level in the history of the sentiment.
Of course it is, but it's not real. It's
not real. And to give you an idea, comparatively, the prior low was during the Great Recession of minus 34.
Yeah, fine. It's an artificial data point, effectively, unless there is no other side to this chasm. Then
Sure.
It's very real. But we're choosing this. We're deciding to have this right now for another reason. But if you saw this kind of data when we're trying to play the game and we're trying to win the game, and this is the data we end up with, that's a very different thing than when we've all just, there's an implemented strategy that one of the very known, collateral consequences of is no economic activity, then sitting there poring over, exactly how awful the economic data is compared to, the grand sweep of history is going to lead to some real shocking clickbait headlines, but it doesn't mean the same thing.
Right. One thing I found interesting is that 7% reported that conditions improved over the month, and I gotta find out who that 7% is, because you gotta figure maybe it was some of the semiconductor players or Netflix or something like that. But
Sure.
85% said it had worsened. Now here is where I found it interesting in that in the New York Empire report, but that is kind of what we're looking at. Firms anticipating only a small improvement in business conditions over the next 6 months. This edged up 6 points to 7. And the indexes for future new orders and future shipments declined, but did remain positive. And this suggests that firms expect orders and shipments to be modestly higher in 6 months compared with this month's levels. Now, that's
And that's an
March.
interesting read, yeah.
Yeah. So that does provide us with that chasm that you're being able to cross that chasm that you talk about, because that takes us into that September, October timeframe, which is where we really need to see. And I think those forward-looking surveys are going to remain key, but it's tough to really take these numbers with a grain of salt. When you
Yeah,
agree?
no, right. Yeah, but the people answering that survey don't know the answer to the fundamental question in play.
Right. So, moving on, the sentiment data from Sentiment Trader, nothing particularly jumping off the page here, Brett. It's kind of the same numbers we took a look at from the AIM and Robo, small trader, put buying, inverse ETFs, equity hedging. They all remained in the overly pessimistic area. But I would be curious, do you have any thoughts on any of those in terms of the market move that we've seen, that they still remain in some of those areas?
Well, first of all, let's frame why this is important in the first place in this situation. So there's this binary outcome situation to a large extent. I mean, obviously it's a spectrum of gray. It's not black and white. But what are people positioned for? What are their core assumptions? And a lot of that has to do with self-preservation through a very risky period. And if there's a decent risk of catastrophe, then you position yourself to survive catastrophe more than you do to take advantage of the lack of that catastrophe. And that's just a general kind of rule that's going to govern the way that people are acting in this environment with their capital. But that highlights the big idea here, which is understanding how people are positioned lets you see what sort of shifts might kind of give way to what sort of moves in the market. And right now, pretty much across the board, as you've covered there and we're covering throughout this, there has been a buying into the idea of extended catastrophe that defines a lot of the movement of capital. It was really, really easy to take advantage on the short side in the market, especially during the first half of March, because there was a retained sense of hope. There was an unwillingness to buy into the potential that this would turn into what we're seeing now, inevitably. And that led to some very easy shorting opportunities because we had that kind of sense of people still really being positioned speculatively, retaining positions that would need to be de-risked, and all of that had to unwind itself to start to price in from a probability standpoint the potential for ending up in the kind of reality that people are now very at home in assuming. And the question is, have they gone too far with those assumptions, and where's the positioning now, and can we kind of slosh back across the middle of that process? So at this point, I think that the big message from most of the things that we would typically look at when looking at a sentiment flow, when we're looking at some of the sentiment trader data points, the robo ratio, the equity hedging index, aspects like that, different put call ratios, different averages of put call ratios, and also looking at some of the fund manager surveys in terms of cash levels, in terms of exactly how likely recession is seen or an extended recession and the duration of the recession, where leverage levels are at. All of that seems to say that right now, and even after this bounce, that we've got a pervasive sense of being sort of braced for a continuing storm that could last a great deal of time. And I think that's the main message from sentiment data, just 30,000 foot.
Yeah, and I think arguably the most interesting debate is around the AAII Bull Bear ratio, where we have seen a bounce back in that data, but not to the degree that one would associate with the move. First off, one of the big questions that people are asked or noting particularly on the bull side, is we never really hit the extremes on pessimism that one would associate with a market bounce. That's been raising a question on this debate. We've never seen the S&P rally 10% in 4 weeks with the bull ratio below 50% until we did just recently. And the bull ratio has also increased less than 5% over this entire bounce. The only time that you could kind of find conditions similar to this, Brett, would have been November 1998, which would have been after the LTCM drop, I'm assuming. And then, of course, March 2009, where it really took a while for people to warm up to the idea that we had gone through the shallows of the great financial strike. Recall in 2009, some of the economic data that we were getting was some of the worst data that we had seen, yet the stock market was able to rally through that. Obviously, the argument of the stock market being a forward-thinking instrument certainly plays out here. But do you have any thoughts on the AAII data that we've seen? Obviously, we're kind of in an area where it's really difficult, I'm sure, for a lot of these survey respondents to answer with any sort of conviction. And I'm sure if you were able to take a look at it, because it's a pretty simple question on would be higher or lower, that there would have been a lot of caveats with any of the people associated with their answers. What's your thought on that AAII survey, and is there any particular read that you're looking for moving forward?
So for this instrument, I have generally looked at the 4-week moving average, and I've looked at it as something that really needs to kind of fester at one extreme or another to really give a strong signal. And the lack of a really strong signal is not in any way suggestive of something. So there's two ideas there. So I completely throw away the idea that because it hasn't hit an extreme, it means something can't happen. There's tons of extremes historically with that instrument that are not marked by, they're extremes in the market, but they're not extremes in that instrument. That instrument does in no way always show, extremes of bullishness at a major high and extremes of bearishness at a major low. There's lots of major lows and major highs where that was not the case. So that's one thing. So it's sort of like a false positive, false negative idea. But where it is something that you really need to pay attention to is when the 4-week moving average spends a lot of time in one extreme or another. So I think that early in 2016 was one of the best reads, and it was a bullish read from that instrument because it had sat in extreme territory for like 11 straight weeks. And it kind of shows a sort of period of time where you're always looking with these sorts of instruments to be able to translate from an opinion survey to insight about positioning, about whether or not there's major speculative involvement in a market or a complete absence of major speculative involvement in a market. And just because right now it hasn't gone to an extreme one way or the other doesn't, in my opinion, really tell us anything. So it's just, I cross it out in my mind as far as providing a read at all.
Right. So with that in mind, Brett, I'm hoping that this is going to work out. Popping up a chart, Brett, I sent these to you earlier, the Justin Mamis Sentiment Cycle, and then Jason Geppert from Sentiment Trader had a pretty good underlying chart that also included the S&P action. So right now we are in the midst of a bounce that is running us towards the anxiety discouragement area of that sentiment cycle. Now, I know you talk about sentiment a lot and about cycles similar to this. I'm curious as to how this matches up with your own readings. And obviously, things got accelerated pretty quickly here. And when you're looking at the secondary derivatives playing in to it, that obviously has allowed this cycle to probably speed up from the normal one that Mamis presented us a couple of decades ago at this point. You got any thoughts on this current activity of where we are right now?
So first of all, I think everybody, if they've never read it, Justin Mamis's The Nature of Risk is one of the best market books you could ever come across, and he's just a brilliant person. Um, I think that this is still something that's difficult to fit into the schema that he developed, and this is really something developed over just a lot of market history research. Just because I think that what we're seeing right now is 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 so outside of the typical kind of cyclical framework of thinking about markets and thinking about the economy and thinking about opportunities for companies to excel. And just like we talked about earlier, it's sort of like we're choosing what's happening right now because of this other threat. It's not kind of organically embedded in internally into the economy to be going through this process. The the economic consequences and the earnings consequences and therefore the pricing of equities in relation to them are all kind of collateral consequences of a policy decision. And I think that that may kind of take us a little bit outside of this typical framework. But there's no question the notion of discouragement and or you can think about the other cycle with pessimism and skepticism and optimism and then exuberance as kind of defining the process of a normal market cycle. All of those ideas are still relevant, which is why we're still talking about sentiment data, because again, it's all about reading through and understanding positioning, because the biggest moves and the biggest opportunities in markets are when something happens in the world that people are not positioned for en masse. So you have the largest repositioning dynamic possible. So right now, I think that we have gone through, and it's interesting that we've moved as far up the charts as we have in the course of this bounce. But I think that we've moved into this position again that's sort of on the fence about whether or not it's possible to move past this, come back out of this sort of policy enforced version of a recession, rather than maybe a business cycle recession or an organically grown recession based on how people have exposed themselves in different ways. We've moved back into this kind of midline fence position about whether or not we're going to be able to see around the corner, paper over top of this, and move back into the world that we saw before this. And I think there's plenty of reasons to be skeptical about that possibility. And I think that certainly, unquestionably, in many ways, there's no chance of just simply returning to the world as it was. But being able to, recover ground in terms of the market, I'm not sure that the framework that Mamis had developed and the framework that we would typically look at corrections and bear markets and recessions is necessarily all that applicable. But that being said, I would still I would still see it as being just about impossible that we simply sit here in a range and then move right back to the highs without going through a kind of reassertion of the downside to some level. And I think the real question is going to come out of any evidence that we see telling us about duration as to whether or not we make a higher low. My bet right now is that we're going to see a higher low when we start to correct out of this pattern. But I don't see the typical framework being totally applicable, because again, I think this is something that's just completely different on a qualitative basis in terms of how we're dealing with it, in terms of its origins, in terms of the cause.
Yeah. Yeah, so I mean, it's going to be interesting to see how this continues to play out. But I agree, there's just such a big variable this time around that it is tough to get in, to gather too much information from historical data. But with that in mind, too, Brett, let's move over to the Bank of America FMS survey, which is the Fund Manager Survey, provided on a monthly basis, and it really gives us a great insight into what people are looking out there. And as has been the case with so many of the economic data points and sentiment data points, we are seeing just historically high numbers across the board. And I think the big one, and we could just get into this right off the bat, because the other numbers, they're good to know, but this is kind of the key one. That's the cash level jump, Brett, where it went to 5.9%, meaning fund managers had nearly 6% of their portfolios in cash. This is the highest level since the 9/11 terrorist attacks, and could suggest that April's in peak pessimism. And I guess it's probably the one thing if you're a bull, that you really have your hat to hang on right now is similar to what we were talking about back in September and October when we were just kind of climbing a wall of worry. There was the trade battle going on that seemed to it was getting worse, and people were starting to fear that there could be military aspects to that and everything. And everybody was wondering why the markets were just kind of staying where they were and weren't selling off. And a lot of that had to simply do with positioning, where people just were sitting on the sidelines. And we're seeing very similar data to that now. Brett talked about the cash level there. 50% of the fund managers and investors say that they were overweight in cash relative to the benchmark. The previous high on that was 49%, which would have been in October of 2008. The investor current ratio of gross assets relative to their capital are at the lowest levels at 0.9 since
which
March,
is leverage.
which is the lowest since March of 2009. Most crowded trades remains the U.S. Treasuries, which was 31%. The second most crowded trade, not tech stocks, not growth stocks, but cash at 20%. Along the U.S. dollar at 18% was the third. So you take a look at these numbers, Brett. Another one being equity allocation, the lowest since March of 2009. Let's see if there's anything else that I'm missing here on this particular area. I think that's the key numbers that we wanted to take a look at from this aspect. And you can see, Brett, just an immense amount of money on the sidelines. You couple in the amount of monetary and fiscal stimulus, and then you just factor in the people that are calling for the market to hit all-time highs, and people just scratching their heads. How can you make this call when the economic data is so bad, when the conditions out there with the healthcare is so bad? But when you look at some of these cash positions, Brett, you could really kind of see where this market could blow off from here.
Yeah, I mean, yeah, right. So look at I think only 15% of respondents for that survey said that they believed that we were headed for a V-shaped recovery. So, I mean, the positioning isn't there for that. It may not happen, obviously, but anything that pushes us in that direction, there's going to be this enormous kind of fuel behind everything because, again, we've talked about this before, a lot of what the Fed is doing, and not necessarily the stimulus checks, not necessarily, I mean, there's elements to what we're doing on the fiscal side that will be taken back, but a lot of what is happening right now, people are going to be, without some kind of serious inflation problem, they're going to be really reluctant to take these tools away. And so if we start to get something that can found a sort of optimism around a V-shaped recovery or something that's ahead of schedule as far as how we're getting things back to normal, a lot of the stimulus is not going to immediately go away.
Well,
and there's a real risk of just things spinning off into the sky.
I think, Brett, just to kind of emphasize your point so everybody knows the numbers that you are referencing here, 52% of the fund managers were expecting a U-shaped recovery, so a little over half. 22% saw a W-shaped economy, and then 15% were expecting a V-shaped economy. So you got 52% of the people, and you talk a lot about the game that these managers have to play in terms of the worst thing that they could do is miss a rally. And
I think you got to throw in the W-shaped and the L-shaped. In that, that's all the people who think that any kind of recovery that gets started is not going to last.
Well, I did see the W-shaped was 22%. I didn't see a number for the L-shaped.
L-shaped is 7%. So
7%.
You've got 15% that think V-shaped and 85% that see some form of, the recovery attempt failing on some level or not even getting started. So it's just 15% that are, that are of the belief that we will see a V-shaped recovery out of this, and everybody else is not positioned for, does not buy into the idea that this could be over soon and, powerfully.
And
I, and I'm not necessarily saying that I believe that. I'm just saying you can read through to the positioning there. Like that's
yeah,
what people are
that's the
unprepared for. There's
that's
no
the
question.
FOMO. That's the FOMO, right? I
Well,
mean,
that's the possibility. I mean, like if let's say test and trace is set up really well, and you basically were in a situation in 30 days where you're walking around town, you get a buzz on your phone, you got to go get tested. There's a test you can get 15-minute results. It's a mile away, and it tells you basically, hey, within the last 10 days, you were within 10 feet of somebody who just tested positive. You need to go get tested. And this is all coordinated into how we're living our daily lives. Then you'll very quickly know that certain communities, there's no presence of coronavirus there. They're just kind of going back about their lives completely, and they have the confidence to do so. That's not necessarily going to happen. I think it's probably unlikely it's going to happen over that time frame, but it's not impossible. And that's, we can start to see potentially what I would call the evolution on the duration front. The evolution on the duration front is going to be everything here. And if we start to see the evolution on the duration front tipping in that direction, then there's a massive repositioning that's going to happen, especially since a lot of this stimulus is not going to come back out. And we can see hard data here that people are not positioned for that. That's not where we are. People are not positioned, hopefully.
yeah. Real quick while we're talking here, Brett, just keeping an eye on things. Looks like people are expecting President Trump to announce the hiring of hundreds of people to the CDC in order to provide a tracking system here. Probably something that they should have
Which
been
is kind of
doing a few
kill
weeks
two birds
ago.
with
But
one stone, too, right? Temporary jobs.
yeah, temporary jobs. I guess the money that they're not giving to the WHO, they could give to the CDC to hire them and stuff. But I do see it. You can see where that blow off top can formulate here, like you were saying, Brett. So just in terms of positioning, expectations, and everything. So that's what we're watching. I mean, again, I'm more of closer to a W-shaped recovery idea myself, but it's something that's got to be respected here. So, taking a look at some of the other numbers, Brett, and if there's anything from the FMS survey that you wanted to throw out, by all means. But 93% are expecting a global recession in 2020,
Which is already in the books.
which is
Might
already
as
in the
well be
books.
150%.
But do you see this as a recession with an asterisk by it?
I kind of do. I mean, it depends on, well, so it can evolve into something more. And again, that's, this becomes something more if we can't solve the problem. But right now, again, it's collateral consequences of a policy decision.
Right. Now, here's one of the things that I'm going to touch upon in a second, Brett, but most investors think that the GDP cuts are largely over in terms of expectations. We've started to see those 40% decline
Yeah.
numbers for
Where are you
sure.
going to go from there? So
But
eventually, you got
but
to get to
yeah,
the end of,
exactly.
right.
We could go to 100. Can't go
Right.
past 100. But
Yeah.
of interest, and I'm going to show a chart here. Global EPS cuts are just beginning, and that kind of
Yeah.
falls all into that valuation argument. I know Pat O'Hare posted a nice comment 2 days ago. I think it was under the TalkX button, where he kind of discussed valuations being at the high end of the range, and that's before we've seen some of these EPS cuts. So that's got to be factored in, and that's probably the primary reason why I don't think that we are in for a V-shaped recovery. But that's
Well,
going to
let me bring up an idea there. So there's a time frame issue. So look, building permits weren't bad this morning. Did you see that?
yeah, building permits and
And a lot of
starts
those
hung
permits
in.
you're starting projects that you maybe really going to be doing something with 6 months from now, but you
Right.
still got to get the permit, right? So there's a reality that exists around the next corner. And when you look at valuations, you can kind of make a little bit of the same argument that should stocks be pricing for how they're going to do over the next few quarters, if that's really, again, a collateral consequence of a policy decision and doesn't necessarily say anything about the long-term cash flows that are going to be associated with that business, et cetera, right?
It does,
You
but
see
I
what
mean,
I'm saying?
I completely agree. But what do we do? So we got the permits number from March. What do we do if we're sitting there going through this earnings season and a lot of the home builders all of a sudden start hinting that the cancellations are going way up?
No, but I mean the market. Similarly, the market may overlook the meaning of that if it believes the duration of this, again, collateral consequences of a policy decision may not be that long-lived. That even though it knows there's going to be an awful quarter,
Right.
or maybe two awful quarters, that investors may still say, I want to own that stock because I think that over the next 5 years that company's going to make a ton of money.
Yeah.
You know, it doesn't imply anything about the lack of viability of that business. I think there's unquestionably going to be structural impacts from the process that we're going through right now, and I've talked about that a lot in terms of, I think a lot of companies are going to find they don't need an office. You know, they're like, wow, this is great not having an office. We're not going to renew that lease, and commercial real estate companies are going to be in trouble. There's a lot of little things like that. You know, it's market penetration for virtualization. It's market penetration for e-commerce. There are communities that weren't really participating in the 21st century in some rural areas that suddenly have to. And, you know, suddenly they're like, wow, this is great, ordering stuff online and getting it delivered. And it takes away a little something from the way their communities were working before this, simply because it's more people, you know, acclimating to a different way of living and then realizing that they might as well stick with it after this crisis is over. I think there's a lot of things like that that are going to happen. But as far as like something like a valuation ratio on forward earnings, there's going to be, obviously, we know there's going to be this god-awful quarter or two. And if the duration is limited, if we're past this and we're returning to a different kind of something like how we used to live, maybe with some kind of augmented sense of, you know, testing and tracing embedded in our lives by, let's say, mid-July, you know, there's the other side of this. And I think that we may see some high valuations that persist and, you know, really are difficult for bears to handle because they just doesn't match historical precedents. The stock shouldn't trade at this kind of PE, but the market is looking around the corner. And it's looking at what the cash flows from that company are going to be for the next 5 years and understanding that this is not a relevant data point in contextualizing that. You see what I'm saying?
Yeah, no, I completely agree with you. But I mean, it will be something that will play in, and we'll get into this in a second, into their financing of debt, and that's kind of the bigger issue.
So there's certainly some issues that, yeah, I mean, there's a kind of financially inflicted reality that can also enter into the equation.
And with that in mind, it's no surprise that 79% of the respondents wanted corporations to improve their balance sheets, which is the highest in 20 years.
For that exact idea, right.
Exactly.
So, I mean, you protect up because you want to survive this because things are going to be okay eventually.
Right. And just 5% wanted corporate buybacks. So this is going to be the one thing that we're going to see, certainly, Brett. And I suppose the arguments will range across the board on how much did the share buybacks boost the stock market over the last 5 years. I think that's a valid argument, but I think probably offset by the amount of fiscal and monetary policy that's been put in there. Do you have any thoughts on that?
Well, I think that's reasonable.
Okay. So obviously we're seeing that move in, and with the next number I'm going to lay out, we'll see again how the credit events play in here. But 57% said that the COVID 2019, and I think I got the chart in for this. I'll drop this onto the page for people. Again, I'll be curious to see how this turns out. Hopefully it's okay. 57% of respondents in the fund manager survey saw coronavirus second wave as the biggest tail risk here. No surprise, that plays into your duration. 30% for a second saw systemic credit events being the primary issue, and that again plays into that earnings and ability to finance interest rate payments come in. And then, funnily enough, Brett, third biggest risk to the market, V-shaped recovery. It really plays into what we're talking about, where you could see that FOMO trade come out. But and then obviously a Democratic sweep in 2020, that's fallen pretty far off the wayside, and climate change is no longer even on there. Looking at bigger fish to fry, if you will. So you got any thoughts?
So, I mean, but let's point that out again. I mean, you've got fund managers identifying what they see as the biggest risks.
Right.
You know, and they're thinking about, you know, their fund. What's the biggest risk to their fund? And the V-shaped recovery idea is interesting because, yeah, I mean, I interpret that to mean that because they're not positioned for it.
Yeah.
And
That
it's a risk. If that happens and they're not positioned for it, that is a risk to their business.
exactly. That's the upside risk, and just really incredible to see that kind of playing out
Very
here.
rarely would you see a situation where something that would be the market going up a lot being seen as a big risk to
Yeah,
long-only fund managers.
yeah, really amazing, really amazing. So,
Yeah, I think
uh,
that's important to ruminate on.
yeah, so I mean, the point being, I think, in all this is you can't just dismiss this rally, no matter what your belief is or what's going on outside in the world. It's something that just needs to be followed. But Brett, the last thing I wanted to touch upon was the IMF Financial Stability Survey. Now I know I sent this off to you a little bit late. Did you have time to prep for this aspect? I know you're smart enough to talk about it off the top of your head, but um, I think the one thing that I really wanted to touch upon was this chart here. And again, hopefully it's reflecting where we're talking about earnings and the interest cover ratio of global non-financial publicly listed corporations. Now, with this in mind, there is one particular aspect that the IMF was talking about where they discussed, and I know this goes into um, uh, Brett, the kind of fake numbers that we're looking at given the conditions we're at. But when the world GDP contracted by 0.5% in 2009, now the IMF's looking for a 3% contraction at the current time in 2020. The pre-tax earnings of global non-financial corporations fell 45%. So when you look at those numbers, you can kind of see that play out in the chart. Hopefully it's legible, where the black line there is the EBIT number, that's earnings before interest and taxes. And then we've got the other number, which is the interest cover ratio, which is EBITDA uh, divided by interest expenses. And you can just see that really kind of collapsing here. And that's kind of the concern. Has the central bank and monetary policy system done enough to offset this concern around financial stability? Now, again,
Well,
listen,
let's just say, I mean, this is about whether or not this becomes a solvency issue,
exactly. And again,
effectively. And
that
yeah,
falls into the 30% risk category too that we just discussed.
right, but that falls into the duration argument as well. I mean, we can again,
Exactly.
it doesn't matter how deep the hole is; it's how long the bridge has to be.
And with
We can
that,
paper over that,
and with that,
but not for a year.
yeah, and with that in mind, I think it is important that the bank commentary over the past couple of days has suggested that this financial stability has set in here. So that's definitely important to know. But outside of the duration, with that IMF financial stability piece that I sent you off, Brett, was there anything that was sticking out to you?
Say it again. Sorry, I missed that.
With the information I was sending out to you in terms of collateralized loan obligations and things of that nature, was there anything that was jumping out to you?
Um, no, give me more. Sorry.
Oh, well, I mean, it's basically what's in play here, and that is the fear that banks or that non-financials more than anything, the banks are pretty well situated, won't be able to cover their their interest payments or their financing obligations. So, just talking about some of the moves that we've seen from, say, asset managers that have been forced to sell, really kind of amplifying that doom loop. We have the emerging markets like India, Brazil, and Mexico that don't have the ability to print the money at the same degree that the U.S. can. So, obviously,
Yeah.
again, it just falls into the duration argument. But is there any areas where you'd be watching in particular, Brett, that could be more of a cause of concern for you?
I mean, look, we're looking for breakdown in coordination. We're it's a situation where if we could choose to wave a magic wand and bail everything out just right, we would. So it's not about assessing who has the right to be bailed out, because the system doesn't work without basically bailing out across the board. It's, can we coordinate the process? And I think, yeah, I mean, it's a huge point to bring up the emerging world and how this is going to play into how the developed world is able to get past this situation and the degree to which that we can coordinate beyond where that. I mean, whose responsibility is it to help emerging and frontier economies paper over this process when they don't have, I would say, essentially the credit standing to be able to do it themselves, and they're not really in league with one of the major developed world central banks. And I think that that's a huge question mark. I think that there's a couple of big question marks. And one is that one, and the other is, I think, on the other side of this in terms of the sort of risk that I think we have in terms of an increase in populism around the world and in, a sort of political backlash to how we're dealing with this. There really is no other choice, but there's going to be an exacerbation of political polarization that's going to be another risk factor. So and that's kind of like the same thing in a way when you're looking at sort of the haves and have-nots, and the have-nots suffering a great deal more than the haves throughout this process, and then there being a massive political backlash after the fact. And I think that the emerging markets are part of that. But I mean, I'd love to get your thoughts. Like, do you think that do you think that just that factor alone is going to cause ripples that are going to be let's say the other low in the W?
Yeah, I do, and that's why, like, I haven't been in a rush to buy stuff. I think that this is going to be extremely difficult to get past without any sort of hiccup. We saw it today. You were talking about implementation, and I took a shot at a short after those PPP headlines started coming across for the small business loans. I know it was expected, but the way the market was acting, I was looking to see if we'd roll over on that. I think that at this point we're saved from that particular headline because people believe that another 250 billion is coming down the road here once we get past that political gridlock. But there certainly is risk that other programs won't be able to go in. In particular, with the swaps that the banks have been doing with other countries, I think that's an area where we'll have to pay particular attention to in case that starts breaking down and the Feds are simply not able to help continue to finance some of these emerging markets. It's definitely going to be an area that we need to keep an eye out on. And the PPP is just the first incident where we saw a lack of coordination. Certainly, hearing some grumblings about the unemployment payments that are going out too, as well as that $1,200 stimulus check that we're seeing different people having trouble getting access to those checks. So there's definitely some logistic issues going on in this monetary policy, and I'm sure the fiscal policy will follow suit, that could be cause for concern. Right now, Brett, I just put up when we're talking about some of the different conditions out there. I talked about the banks and how well situated they are. The chart that I have up there, Brett, this is that figure 110 from the IMF Financial Stability, where they talked about global financial vulnerabilities and pre-existing conditions. And this is an area that you really need to be on the lookout for. For instance, it breaks down the second part of that where these vulnerabilities are in sectors by region. And they break it down to sovereigns, non-financials, households, banks, insurers, asset managers, and other financial institutions. And you can see the number of reds that are out there. In Europe, for instance, sovereign is a deep red there. Some of the other advanced economies are in better condition here. Households are in generally good shape, but when you start looking at China or other advanced economies, you start seeing some more red there. The non-financials are red in China, as we've read plenty of those issues over the past. Banks, they're green in the U.S., but they are red in China and in trouble in Europe too. So another area of issue. Insurers, which are the obvious backdrops, that's not in as bad shape as some of the other areas. Europe actually happens to be an outperformer here, and China in line, but that's an area where there's some trouble there. Asset managers, that's a red area here in the U.S. We certainly saw a lot of them dumping dumping positions during that decline. China's another area where this is red. So you can see that while the banks are in good shape, there are other areas that are cause for concern. But that's the reason why I simply can't get behind a V-shaped recovery. And again, I could be wrong because it continues to fall back to that duration argument, Brett, where if we are able to gloss over some of these financial stability concerns, that we are able to get over to that next level. But what happens down the road, Brett, if it's not necessarily a healthcare issue, if there is something a little bit more structurally at play here, and I think that's kind of the cause for concern and the red flag that raises, and the main reason why I'm behind more of a W-shaped recovery than a V-shaped.
Yeah, no, it absolutely makes perfect sense, and I think that's why positioning looks like it does. And it's not just because there's a lot of people who are not positioned for the market to have a V-shaped recovery. In no way suggests that a V-shaped recovery is more likely. It just simply shows the upside volatility that could happen if the context evolves in that direction. And if you're looking for key indicators of a breakdown in some of these sort of associated elements of the grand financial landscape around the globe, I think the big scary thing to see right now would be an inexplicable and accelerating rise in the value of the dollar.
Right. Right, which we haven't seen yet, but it is just the Dixie is just kind of bouncing around that 100-point level here. We'll pull up a chart of that. So we've got that on. I'll move this off to the side.
That would be a very bad thing to see right now.
Yeah. Yeah, that is exactly what you don't want to see. And this is the dollar index right here. I'll throw it up on the daily. You can see it had that big pop up to 102. So, Brett, when you are looking at the DXY chart, what's going through your head in looking at that?
I mean, if the dollar is the global reserve currency, a lot of debt is denominated in dollars, and if you see it start to race to the upside, it starts to show the possibility of sort of a catastrophic, global, pervasive kind of credit crisis taking shape, which is, if the duration argument ends up being, its worst case scenario, you're just going to see one side of the ledger for the global financial system kind of gradually go poof. And, that's going to be sort of, the dollar's just going to be in a parabolic run. And I think you'll see the risk. And you can look at that, the Dixie chart, you could see that run that we were seeing while the market was crashing because people were starting to position for the possibility. And I think that a lot of that probably is even using, exposure. It's flood into cash. It's deleveraging. But it's also, the idea that that's the one thing to own where if we do see kind of a globally pervasive kind of, credit crumble, then that's going to be also the best hedge.
Let me ask you about this scenario, Brett, because I think it's kind of the one that would probably prove to be the most interesting. If we did get that V-shaped recovery and then the FOMO trade, and obviously this is an economy that could potentially be on juice with all the fiscal and monetary stimulus here, but we did not see the healthcare data kind of support that move. That's still they flattened off a little bit, but there's still no vaccine on. There still wasn't a good testing system that was around. What would be some of the things that you'd be looking at in terms of trying to recognize a FOMO blow off top, and what scenario would you want to see play out? And I know it'd be tough to project this given all the variables that we just discussed, that you think that would make it just arguably the best shorting opportunity in our history, perhaps.
I mean, yeah, I guess I suppose that if we are moving higher because of really intense social distancing has quelled things, but there's really no solution. For some reason, we can't get test and trace going well. We're seeing vaccines fail in human trials, but because of massive social distancing, we've suppressed the virus and we come back out of or reopen the economy, but in a way that would suggest that, just because you see that activity happening then, we can see a reacceleration in the virus. I suppose. I mean, we end up right back here again. In other words, we're just kind of going through a roller coaster.
Well, I guess
But
in a step by step, then, what would be the FOMO blow off top that you'd be looking for? What kind of stock action would you be
I
looking
mean,
for?
I don't know if I can see there being, a giant squeeze higher that is. I mean, I guess what you're suggesting, but you're saying that if it wasn't founded by some kind of qualitative positive change in the
Correct.
pandemic
Correct. We
course. But
saw the
how would that happen in the first place? I mean, it seems difficult for me to see the market taking off to the upside with no solution to the healthcare problem.
and I completely agree. But I guess the main question for me would be, how would you see a FOMO trade kind of playing out without the healthcare aspect of it, or do you just think that that's kind of impossible?
I guess I think it's impossible. I think the level of pessimism and skepticism that's built in, and I think it's so pervasive. I mean, where people are living, even asset managers are living in a world right now where
Yeah.
they're confined to their home and they go to the grocery store with a mask and gloves on. Like that makes it really, viscerally forceful on the intellect that this is a kind of apocalyptic moment. It's really tough to get, super bullish unless you feel like you can see around the corner of the cause of that. So
Right.
I don't know if I can see the market just taking off to the upside. And, I mean, I suppose you could see really large cap tech. And so maybe the NASDAQ could squeeze back up near its prior highs and really diverge from the S&P and Dow and small caps just because the economy becomes entirely about, Amazon and Netflix and Google. And I suppose that there's a possibility of a different kind of, Amazon's quarter is going to be very different from anybody else's. Netflix quarter is going to be very different. So there's the Nasdaq so dominated by a small concentration of mega caps that I guess that could possibly happen for something like the Nasdaq 100 index. But it's tough for me to see the S&P taking off to the upside, given this situation without it being ultimately driven by a qualitative change in assumptions about the duration theme.
So that would be the black swan for the upside, I suppose, right?
Oh, I would think so. I mean, I think that people are right now with embedded positions, and we've talked about it, a framework that assumes that there's no chance that we're going to see something like, a meaningful return to normal economic activity in 2 months' time. And if we started to see something that shifts that picture, which I'm not suggesting that that's likely. I'm just pointing out the vulnerability. The point of analyzing sentiment data is to see where the vulnerabilities are
Exactly.
in terms of positioning.
Last question for you, Brett. Lawrence Fink, CEO of BlackRock, laid out a scenario where he saw a boost to inflation in 3 to 4 years from now, given all the monetary and fiscal stimulus. I agree with them. I know I got a GLD position. I believe you still do, correct?
I do not, and I
You
probably
do
should.
not. Okay. What's your current take on inflation right now? Do you have one? I mean, again, obviously a lot of variables out there. Um, just curious if you got any thoughts on what Lawrence Fink said. Obviously, you could see where he's coming from. Now, the counter argument would be, well, if we started seeing that sort of inflation, then we would see a pullback in some of the stimulus that's out there. But do you think that we could potentially be at an end of the low inflationary period, given the amount of moves that the central banks have made?
I mean, I certainly can't say that there's no chance of that because obviously, we are taking unprecedented steps, but we've been here before in a way. We took some, relative to history, leading up to 2009 and 2010 and 2011, what we were doing then felt just as striking relative to history as what we're doing now feels like relative to history in terms of, some of the unique and dramatic policy moves that we're making that, powered a gold bubble that then collapsed. And powered a massive increase in inflation expectations, very similar to like what you're reporting from Larry Fink, that you just look at the amount of money that's being created and, well, that's got to lead to inflation. And I think that, the lesson then was, well, how much is the demographic backdrop supporting that, and how much is the credit system going to be able to kind of fuel the process. And I think I tend to lean toward demographics. If you look to over a very long time frame, the essentially becomes about the year-over-year change in the size of the labor force for people who are 25 to 54 years old is probably about the most long-term correlated factor you can have with very long-term structural trends in inflation. So when you have a lot of people who are 30 to 40 years old and not very many people who are really, really young and very many people who are really, really old, you tend to have higher inflation historically. And if you look at just demographic patterns now, one could kind of see, somewhere between 2025 and 2030, we're going to have a situation like that again because of where the millennials are going to be in their process and because of probably, where kind of eventually mortality in the baby boomers generation ends up being. So you end up with a big swell in the middle of people who are in the most sort of productive and high consuming periods of their life all at the same time is probably another 5, 6, 7, 8 years off. And I suppose that we could kind of bridge our way from there with policy instruments, but I think that you don't really get that big tailwind until a few years after that.
All right. So, Brett, with that, you want to wrap it all up for us? You always do such a good job at summarizing our discussion.
Well, I mean, I think that we have a situation where the market has snapped back to pretty much around the middle of the crash, and I think that it's not going to be all that easy to understand. It looks like such an easy short, and I understand that feeling. And I see some moments during the course of the last week where I felt extremely high conviction about a quick and easy move back to 2,600 or 2,500. And you look at some of the data coming out. We see the banks reporting. We see their visibility into the future. It's nothing. We see some of these claims numbers. We see some of this retail spending numbers. We see some of these economic sentiment indices that we've talked about. And you can see that we're in this historic awfulness. And, there's a kind of disproportionality there. And again, I think that you really have to force yourself to be in this mindset that, a lot of the immediate data is not going to tell you about how assets are going to value themselves by market forces. And a lot of people can get burned one way or the other by realizing that it's not really going to be about traditional systems of fundamental or even technical analysis. It's really going to be about understanding where we're going to be in September. Are we going to be in a world where we have the tools to deal with this and suppress the impact of this virus and get back to life? Because again, a lot of what we're seeing is collateral consequences of a policy decision. And that is not something that you can really view through the lens of it's analogous to this bear market or that bear market or this recession or that recession, because we haven't really seen a situation like this, I think, ever before. And I think that the data points that I'm most interested in looking at are, on the development of temporary and lasting solutions on the healthcare side, because that's ultimately going to be the gatekeeper to changing the policy decisions, which are the driver of all of the economic collapse in the first place. And I think that if you just look at traditional data points, they're just going to be eye candy and clickbait, and they're not necessarily going to tell you anything about the future of asset prices. Well, one thing we know right now, and we've covered exhaustively in this program, is that people are not prepared for a V-shaped recovery. That does not in any way suggest that that's what's going to happen, but that is the main thing that people are not prepared for.
Yeah, and so that's what we're keeping an eye out for. See if we can't get into that phase. But like Brett was saying, we need some of those developments on the healthcare side really to unleash some of that pent up demand that's out there. All right, I know that there was a couple of feedback questions. We'll circle back around and get to them as soon as we can. We're running on about an hour and 10 minutes, so we are going to end this discussion here right now, but please keep sending in the feedback questions. We will be posting the replay of this shortly, and if there's any additional thoughts, feel free to share them with us. We're always happy to hear, and we will be back probably in a week or so's time just to see what's going on out there in the markets and address any other commentary that needs to be put out there. So, Brett, as per usual, Thank you so much for joining us. Always a pleasure talking to you about this, and look forward to continuing the discussion.
Okay, thank you very much, Gav. Take care.
Talk to you soon.